Welcome to My View On, a series of podcasts where experts in the industry give their personal view on some of the big topics making waves in the media. All the views are the experts' own, providing a fresh look at key issues facing the financial industry. Now here's a question. Capital gains tax versus the annual allowance charge. When should you take a hit on the annual allowance charge? Well, with me to discuss this is Paul Speight from James Hay. Paul, so first question is, what should you do?
Well, we've got a number of changes that are coming in order to limit the amount of the cost of tax relief to the Treasury. So the cost of tax relief in the UK to the Treasury is very similar to the cost of the Education Department, and is actually more than the defence budget. So you can imagine that this is quite a burning topic within Whitehall of where do we, when we're facing cuts. And the Chancellor's really come out saying that his predictions for this year are looking slightly gloomier than he was expecting. And there's been consultation papers during the course of 2015 looking at what alternatives we can have in the UK to this. Now, the outcome of this is that anyone that's earning over 110,000 and then moreover over 150,000 will start to lose the amount that they can pay into pensions. And, that could move from £40,000 down to its limit at £10,000. Now, if you pay over that, it's fine. You're allowed to pay over that amount of money, but you just don't get tax relief. And what will happen is, for any individual where that happens, the amount of money that's been paid into their pension fund above their allowance effectively gets added to their income as though they'd received it as income. And then an income tax charge is obviously payable. Now, if you have got people that are in employer schemes or where an employer is making a contribution, they might not be able to control the amount of money that is going into their scheme because their employer is making that contribution on their behalf. That's typically going to really affect people in final salary schemes, defined benefit schemes. And then the second group of people that will be affected by it is those that may not even know they're high earners. So at the point that they're making their pension contributions, if they run their own business or something of that nature, or moreover they're getting bonuses, then they might not know what the total amount of their income is until after the end of the tax year. Now, for those people, there are prices to pay. So my question really is the price of the annual allowance charge worth paying? And we have more questions into our technical teams on this than any other, working out how much have I actually paid into my pension scheme, working out what their incomes are, working out what's been paid into various different pots from employers to their own. And it's all about trying to avoid this charge. So my question really, is that a charge worth paying when you put what are the options that are available to you?
Well, you posed the question, Paul. What's the answer? Should you take that hit on the annual allowance?
Well, for everybody, that's going to be an individual taxation question that they will no doubt have with their advisor and almost certainly the accountant involved as well. But so my thought is, well, what are your alternatives? So you say to your employer, well, I don't want to be a member of the pension scheme. I'll have that money as income. So it'll come to you less income tax and less national insurance typically. And then what do you do with it? So you've got this lump of money. You want it to save for your retirement or long-term savings. You can't invest it in the pension because we've just discussed that, so that's where it's not gone. You've probably used your ISA, so the people that are going to get caught by this have probably used their ISA allowance already. They would do so every year. So you're putting it into what I would call a taxable environment. And that potentially is where I see some pitfalls that probably need to be considered. So as the money grows, it'll be taxed potentially, and then you have the potential for CGT tax at the end. So you get to the retirement point, you take the money out, and then you get hit with another tax. And I think it's that journey that needs to be considered. So rather than just say, no, I'm absolutely not going to pay the annual allowance charge, I think we need to maybe step back and consider, well, we've got all these new allowances that the Chancellor's brought in at the other end. So changes in dividends and changes in savings tax and so on. Can we make use of some of these? And is it such a bad thing if we pay an annual allowance charge, or do we need to consider where else we put the money?
So what you're saying, Paul, is that by paying that early charge, that annual allowance charge at the beginning, you're potentially saving yourself from paying a raft of unknown charges on different savings further down the line.
And that's exactly it. And in a lot of circumstances, I don't think many clients will know. So you might have a knee-jerk reaction where advisors say, right, because I don't know what you're going to earn, let's just pay £10,000 in because I think you might go over it, and that's fine. But if you're in a final salary scheme, your employer will tell you what you've paid in maybe the October after the April at the end of the tax year. So there's nothing you can do about it. There are different ways of paying the tax. You can ask your scheme to do it, or you can pay it yourself, or it gets added to your income. But I think what I'm saying is, if you approach your employer, so these changes will require individuals to go and see their advisor and then their accountant, and possibly then engage with an employer if applicable. And that will be about not paying this charge. And I think that's not a bad thing. I think that's very worthwhile doing. But I think having got that information, then you need to put in the round of what else do I do with the money.
And of course, we're back to this point again that individuals have been empowered to make these decisions. But in many cases, the kind of calculations they need to make are perhaps beyond the level of financial acumen that you would expect an everyday person to have. So what can people do in that situation?
Well, seeking good financial advice is your first starting point. And those advisors themselves will be engaged with the accountants, I suspect, to understand the implications of it. And there is another school of thought as well that says, with all the changes that are happening in personal taxation, actually saving money outside of the pension scheme and not having it all in one basket or one tax wrapper is probably a good thing as well. So I think really what we're saying from what we're seeing is that the effort that's being put into avoiding the annual allowance charge is obviously well spent, and people should be aware that what potential tax charges they might have down the road. But let's also consider that the way that that's taxed, and if there's some benefits in paying that charge.
Okay, Paul Speight from James Hay, thank you very much.